Okay, so I hope you guys are processing pretty well so far. So this is the class for week 5. We're at October 3rd today, and some people emailed me during the past week, and I have decided according to people's conflicts, I have decided that we shall postpone the midterm for a week. We'll move it from October 17th to October 24th. And I'll be posting an announcement in the new updated syllabus later after the class today. So here's the plan. We'll be quickly finishing chapter 5 today, and then I'll be wrapping up chapter 6. I hopefully today, but yeah, definitely we'll be moving on to the majority of chapter 6. We'll be covering the majority of chapter 6. Here's the problem. The problem is that we're going to have a vacation next week. This is the national holiday. So to make sure that you guys have enough practice before the midterm, I will be posting the second assignment someday within this week, maybe perhaps on Wednesday. I'll give you guys still 2 weeks to work on it, but then I'll give you guys 3 attempts so that you can start working on, it will be covering the questions from chapter 5 to chapter 7. But then you guys can start working on it for those you think you have prepared for already. Okay, so I'll give you guys an additional attempt so that you can practice during the national holidays, the week of the national holidays. Does that sound good for you guys? Okay, cool. So yeah, here that's the plan, and I'll be posting an Let's get back to our course contents. We finished somewhere in, I think on page 13 last week. So what is chapter 5 about? Chapter 5 is about determinations of forward and futures price. So in this chapter, during the first half of the chapter, we have been talking about how we classified assets into investment assets or consumption assets, and then how we could build futures or forwards contracts among these underlying assets. And then afterwards, how do we conduct pricings for such contracts, either futures or forwards contracts? Basically, we do the pricing through the so-called no arbitrage arguments. We try to see what is the correct price that will not allow for room for arbitrage opportunities. That's how we construct our strategies. And why does the screen? Oh yeah, here's the screen back again. So basically, the idea is very straightforward. The futures price that's set up today should be what the underlying assets spot price today, multiplying, throwing it to the future, multiplying it by exponential to the power of RT, where R is the continuous compounded risk interest rate for such periods, and T is the time horizons before maturity of such contract. That's the very naive, straightforward idea, but then there are definitely some variations of when we discuss about the properties of the underlying assets. Suppose it's a fixed income asset, we know that there will be some non-income coming in between the time before maturity. Then what we do is basically we subtract the present value of the non-coming in cash flows. If it's a non-yield, suppose it's the futures contracts on an stock index, and we know that there is some expectations on the dividend yields of the stock index, then basically if we are given the Q, which is the dividend yields also in continuous compounded world, then basically we just deal with it by treating it as a subtraction term to our interest rates. That's what we have been discussing about. We have also been talking about valuing forward contracts. The idea is that whenever a forward or a future is set up, it's always set up so that the price is fair. But then after some time has gone on, we know that things could change. Time to maturity shrinks, and also interest rate may increase or decrease due to any kind of macro conditions. So afterwards, we know that the value of a contract, which is actually the present value of what you're going to pay for, what you're going to get minus the present value of what you are going to expect for the cost. So basically, the value could be positive or negative. So that's what we have been talking about last week. Today, let's continue and finish this chapter. I hope we can finish this chapter within the class. So this is a summary, a generalization of all kinds of futures prices. We have been talking about futures prices of stock index or non-incomes. Non-incomes, you can think of it as a minus term of the storage cost. We'll be discussing about storage cost, convenience yield, and also the forwards or futures on currencies right afterwards. So every time afterwards, when we finish this chapter, if you're doing your review, you can always map all the example questions to this slide. Okay, so I think we can skip this part. This is very straightforward. This is exactly the same example as the non-yield examples. So I think there's nothing much to talk about over here. Let's move on and talk about the futures or forwards on currencies. So this is actually quite interesting because this is something that relates to what you have probably learned in your international finance class, the covered interest rate parities. So what is it about? Let's think about a situation where we are thinking of making an investment on the risk-free rate of between two countries. Of course, we know that if there's a futures contract among the currencies, suppose that's the future exchange rates, then definitely there should be some relationship between the spot exchange rate and the futures exchange rate, and also the domestic interest rate and also the foreign country's interest rate. Otherwise, there must be some relationship. And this is the thing that we will be discussing here. So I think it's the best way to learn this concept is through an example. So let's go through one example together, okay? So now we're discussing a situation where we're standing in the shoe of a US investor, and we're thinking about making an investment, making a deposit investment, a very straightforward deposit investment in Australia. And it has been widely known that the interest rate in Australia has been relatively high to other countries during the past periods. So this was an example. I think this is an example from the textbook, which is, I think, Zhang Ho composed it last year in 2021. By then, the U.S. interest rate hasn't been strikingly high yet. So back to the time periods, interest rate in U.S. was still relatively low comparing to Australia. So yeah, just keep that in mind when you read this example so that you don't get confused. So back then, the 2-year interest rate in Australia and also in the US are 3% and 1% respectively. So it was 1% interest rate in the US and 3% interest rate in Australia. And by the time the spot exchange rate is 0.75 US dollars per Australian dollars, it means that each Australian dollar can be exchanged for 75 cents of US dollars. So we're expressing the value of Australian dollars in terms of the value of US dollars. So now, according to our formula over here, the futures price should be equaling to the spot exchange rate multiplied by exponential to the power of a differential. The differential is the interest rate minus the interest rate in the foreign country minus the risk-free rate in the domestic country, to the power of the time horizons. Sorry, let me correct myself. The interest rate in the domestic country minus the interest rate in the foreign country. This RF over here stands for the interest rate in the foreign country. Okay. Multiplying the time to maturity, the time horizon that we plan to make an investment, the time to maturity of this foreign futures contracts. So what happens is that if we follow this definition, let's follow the definition for now, and let's see what else we can see, what we can do afterwards. Okay, let's take it for granted first. If that was the case, the spot exchange rate was 75 cents US dollars per Australian dollars. It's multiplied by the exponential to the power of, here's the interest rate in the US minus the interest rate in Australia. And remember, we're making this in 2 years. That's the reason why at the end we are multiplying 2. If you do the math, you see that the answer equals to 0.7206. Basically, it means that the fair futures contract should be that we will be exchanging $1 Australian for 72 cents US dollars in 2 years. Otherwise, there will be arbitrage opportunities that show you where the arbitrage opportunities are. Okay. So let's think about it in two scenarios. In one scenario, the exchange rate, the forward exchange rate was lower than what we should expect for. The second situation is that it's actually relatively higher. And we'll see that there is actually arbitrage opportunities in both conditions. Okay, so let's take a look at the first situation. Suppose that the 2-year forward exchange rate was just exactly 0.7. What it means is that there is on the market, there is a forward exchange rate in 2 years that will be expiring in 2 years that people can exchange for $1 Australian for 70 US cents in 2 years. And you know that according to our formula, it should be the case that an Australian dollar is worth for 72 cents. So basically, it means that we have an undervaluation of such Australian dollars in 2 years. According to we know that we always want to buy low and sell. So that's the reason why we want to buy future Australian dollars through these forward contracts. That's the initial point that we begin with. But then construct this arbitrage. Okay, to going a long position to buy Australian dollars using US dollars in 2 years, we first need to be prepared to pay Australian dollars. That's the reason why if we are planning to buy Australian dollars using US dollars, we first need to be prepared for some US dollars, right? So to begin, let's try to borrow so this $1,000 can be any kind of values you like, but let's just treat it with let's just begin with any kind of an arbitrage and a fixed number. So let's begin by borrowing 1,000 Australian dollars at present. Okay, if we do that, then we know that after 2 years, regardless of any kind of trading transactions, we borrow Australian dollars today, so we will be repaying back Australian dollars in 2 years at an interest rate of 3%. That's what we mean by the interest rate in Australia is 3%. So what we do is, okay, first we borrow 1,000 Australian dollars at 3% for 2 years. And we know that the spot exchange rate is 0.75 US dollars per Australian dollars. So if we have 1,000 Australian dollars today, we can immediately exchange it for 750 US dollars right away. And that is exactly what we do over here. Then what we do is we're going to invest the 750 US dollars at the 1% deposit rate. So we know that, and then at the same time, like I said, we know that the Australian dollar future is undervalued. So we want to enter a position to buy Australian dollars using US dollars in 2 years. Let's see how much we can buy. Okay. So we have 750 US dollars at present, and then at the same time we invest it at 1% for 2 years. That is what we are doing over here. Let me zoom in a bit. So here we got 750 US dollar. We invested at 1% for 2 years. So after 2 years, we can expect for 765 US dollars and 15 cents. And if we suppose that we have such amount, excuse me, forward contract, page 17. And then let's think about how much Australian dollars we will be owing people after 2 years, okay? We know that in 2 years, we first borrow 1,000 Australian dollars at 3%, right? And after 2 years, how much should we pay people back? If we are borrowing at 3% for 2 years, multiplying by $1,000, we know that we will need to repay people back of exactly this amount in Australian dollars. So to get prepared, we need to enter into some kind of futures contract, forwards contracts. If we want to be able to repay people back of this amount of Australian dollars, and we are given a forward exchange rate of 0.7. Then how much US dollar should we be prepared for? We need to prepare for this amount divided by, multiplied by 0.7, which gives us exactly 743.29 US dollars. That is what we have over here. We need to pay people back of 1,061.84 Australian dollars in 2 years. And we know that through this forward contracts, we will be able to buy this amount of Australian dollar by just merely 743.28 US dollars. But remember, what are we also doing at the same time? We invest our 750 US dollars into a 1% deposit rate for 2 years. As I mentioned, it will grow to the amount of 765.15 US dollars in 2 years. So now we have 765.15 US dollar, but at the same time, we only need to use part of it, 743.29 US dollars, to buy this amount of Australian dollars back to repay our original debt. At the end, we end up with an extra 21.87 US dollar. That is what we mean by there is an arbitrage opportunity. Does that make sense? So here, let me rephrase it once again. We should expect to see the forward exchange rate in 2 years of an Australian dollar to a US dollar to be 0.72. That is the case according to our formula. But then in reality, according to this, our situation, what we see is that the forward rate is undervalued. So we should be expecting to take advantage of this mispricings. So we try to enter a forward contract to buy Australian dollars using US dollars. To begin, we first borrow some Australian dollars. We directly change it into US dollars and invest it into the 1% US deposit rate. We obligated to pay people back our original debt, and we know Australian dollar, 1,000 Australian dollar will grow at 3% for 2 years. So at the end, we will be owing our people 1,061.84 Australian dollars in 2 years. So that's the reason why we want to get prepared, and then through our calculation, we know that we need to prepare 743.29 US dollars to buy this amount through this mispriced forward exchange rate. And then our original investment will also grow from $750 to $765.15. At the end, we end up with some extra values. And if this exchange rate, this forward, the mispriced forward exchange rate stays there and holds no matter or even like 1,000 times, and then that would make your profits 100 or 1,000 times. So that's why we call it an arbitrage. Okay, everything okay so far? Now, yeah. The Australian forward contract. Yeah, we want to take advantage of this mechanism, this contract, and we want to use this contract, and we are standing at the side to buy Australian dollars using US dollars through this forward. That's the idea, because it's underpriced comparing to the right level. Okay? Yeah, so to be honest, during an exam, this is the way I do. So during an exam, if you cannot tell what is the direction that you should take, you can just try both two directions, and then you'll end up with just merely a different sign, one positive sign and one negative sign, and you know that you want to take the positive signs. So that's the case. So if you get really confused during an exam, okay? So now let's take a look at the second example. So now in the second example, the forward exchange rate is overvalued. It's too much. One Australian dollar is worth 76 US cents in 2 years, which is not right according to our calculations. So we want to take advantage of this pricings, and we want to take exactly different directions. So now let's be prepared to buy US dollars using Australian dollars. To begin, let's borrow 1,000 US dollars at 1% for 2 years and convert it into Australian dollars and invest in under their deposit rate of 3%. we know that we borrow 1,000 US dollars today at 1%. So in 2 years, we need to get prepared for this step. This $1,000 at 1% will grow to the amount of 1,020. But at the same time, what is our Australian holdings? We have $1,000. The spot exchange rate was 0.75 US dollars per Australian dollar. So we just simply divide 1,000 by 0.75. It means that at present, our 1,000 US dollar is equivalent to 1,333.33 Australian dollars. And then we are going to invest the same at 3% for 2 years. So then at the end, it will grow to 1,415.78 Australian dollars in 2 years. And again, we begin by borrowing US dollars. We owe people 1,020.20 US dollars. To repay this back, we need to convert this Australian dollars back to our US dollars. And then how do we do so? We can do so through our forward exchange rate of 0.76. So at the end, we know we can expect for this amount of Australian dollars in 2 years. Then we're going to enter the position to buy US dollars using Australian dollars through this forward rate, exchange rate. Let's multiply this number by 0.76. That's the forward exchange rate. And we'll end up with 1,076 US dollars. But then we only owe people, only need to pay people back 1,020.20 US dollars, according to our original borrowings. So at the end, we end up with a totally riskless 55.79 US dollar profits. That's the reason why it's an arbitrage. And you'll see that this arbitrage would only disappear once the forward exchange rate gradually converge back to this level. If that's the case, then there is no arbitrage opportunity. Okay? Does that make sense? You guys, if you still get a bit confused, I think the best way is to practice yourself. I personally like to draw a rectangle diagrams. So you can begin with, here we have US dollars, we have Australian dollars, AUD, USD. It's now, and then this is 2 years afterwards. So we can draw this kind of diagrams. So take it for one example. Let's take the second example, okay? Because it's actually quite straightforward. So if we borrow $1,000 today, we have $1,000, 1,000 US dollars, and then we exchange these 1,000 US dollars to 1,333 Australian dollars using the spot exchange rate. And what we do is now we invest the same using the interest rate. We end up with 1,415.70. And then what do we do next? We change this thing back to US dollars through the mispriced forward rate. And what do? We divide it. So this is dividing it by 0.75. And what we do over here is multiplying it by 0.76. And we end up with $1,075.99. This is what we have over here. And we begin by borrowing 1,000. So at the same time, it's $1,000 debt will grow at 1% to 1,020.20. So this is what we have. This is what we need to pay people. Take the difference. You know what is the profit that you gain. Does that make sense? So during the exam, this is a way that I like to do. I think this is the best way to avoid all kind of confusions or misleading things, those numbers during exams. So that's the best way I like to do. Okay, any questions so far? Like I said, if you hear it clearly, I always begin by making sure what direction we want to take in the forward contract. That's the first part. we want to make sure what's the direction that we want to do. We know that the fair, the optimal or the theoretical forward rate should be 0.72. We see it's 0.70 over here. What it means is that in 2 years, we can buy one Australian dollar is only worth for 70 US cents. It means that the fair price is 72 US cents. So we know that Australian dollars in 2 years is undervalued in this forward contract, under this forward contract. So we want to take advantage of it. So we want to get some Australian dollars using US dollars through this, in 2 years, through this forward contract. So the first part is, the way I like to begin is, I like to make sure what direction we take over here. Are we going to buy Australian dollars using US dollars, or are we going to buy US dollars using Australian dollars in 2 years through this forward exchange rate? At the same time, in the second situation, it was 0.76. So we know that the Australian dollar was overpriced. So we want to sell Australian dollars, change Australian dollars back to US dollars. That's the thing that the direction that I take first. And then I just back up all the routes. Like I said, to sell Australian dollars for US dollars, we first need to have some Australian dollars in 2 years. So we want to get prepared to invest in Australian dollars for 2 years. To begin, where do we get the money from to invest in Australian dollars? We borrow US dollars, change it through the spot price, spot rate to get Australian dollars to invest at 3%. And then at the end, eventually we can take advantage of this mispriced forward contract. Does that make sense? Any other question? Okay, cool. So let's move on. Commodity futures price. So in the previous situation, we were talking about currency futures. Now let's talk about commodity futures. Commodity futures are just almost very similar. The concept is very similar to the idea of known incomes. It's just that it's now a negative known income. You know that you need to pay some entities to store these commodities. So you know that we have to take this payments into considerations when we are considering the pricing of such futures. Consider a 1-year futures contract on an investment assets that provides no income. It costs $2 per unit to store the assets, with the payment being made at the end of the year. Assume that the spot price is $450 per unit and the risk-free interest rate is 7% per annum for all maturities. What does it mean? So it could be actually investment assets or physical assets. It could be any kind of assets. So think about it's a crude oil. Suppose it's a crude oil and you need to prepare for these crude oil. You need some physical space areas to store this barrels of crude oil. So you need to pay some rent to rent some garage to hold these crude oils. Suppose it costs, like in this example, it costs $2 per unit to store the assets, and the payments are going to be made at the end of the year. So the idea is very simple. We just also discount it to consider what is the present value of this storage cost. The $2 storage cost will be paid at the end of the year. Suppose it was mentioned that it was paid upon the beginning of the year, then we don't have to do any kind of discounting. But in this, according to this question, these payments are made at the end of the year. So what is this $2 equivalent to at present? We just discount it using our risk-free rate over here, 7%. So it's equivalent to paying $1.865 at present. And what we do is very straightforward. We just add it to our spot price and let it roll for exponential of 7%. Multiplied by the number of years of the horizons. So at the end, the futures price should be 484.63. Very straightforward. So take a look at the previous example where we have a known income. Something is coming in. If it's a positive known income, the holder of such assets, say here it's a fixed income property, it will be actually a deduction term over here because it's actually a value deduction to the spot price, to the spot price. Yeah. But on the other hand, for a commodity with a storage cost, it's actually an addition to our spot price, because this is something you need to pay, you need to consider to pay for holding it. That's the reason why here now it's a positive sign, and over here, and if you do your math, you know what the answer should be. That's the idea about storage cost. Convenience in chapter 4, what is convenience yield? Convenience yield are also benefits that you could enjoy by holding such assets. Like I said, if we are holding a US Treasury bill, usually there are some additional benefits of holding it. It could be tax deductions. It could be that there is some regulations for financial institutions. It could be some regulations by the SEC to hold more. If you hold more Treasury bills, they could have lower restrictions on their balance sheet. It could be any kind of reasons. But then for these idea, convenience yield are just a summary of such benefits in terms of also an idea about interest rates. So it's also expressed as a rate of returns in terms of your spot price. So here, what we see over here is that if it's benefits, like what we see over here, known income or known yield, if it's some kind of benefits, then it should be considered as a minus term in terms of the discount rate. On the other hand, here, if we are expressing the storage cost rather than a fixed cost, a fixed one-time cost, if it is expressed as some kind of idea about yields, then it's actually a plus term to the discount rate. So everything that's negative, that's something you need to bear about. It would be a plus term to the discount rate. Well, if it's a benefit of holding such assets, it would be a minus terms. So yeah, here, this is just a summary. There's no, I think according to the textbook, there's no very good example for convenience yield. So I think it's just an easier way to just fast forward about it. At the end, the idea about cost of carry. Cost of carry is another, a larger set about all these kind of plus or minus signs. So the idea about cost of carry could be, if it's a cost, then it could be captured by the plus sign to the discount rate. If it's a benefit, it's a negative sign to the discount rate. You can also express, like what we have been talking about, currency futures, non-income, non-dividends. This C over here is just an addition term to R. It could be expressed as what we see over here. You can express it as S0 exponential to the power of R plus C. C could be an R over here. C could be a dividend yield. If it's a non-dividend paying stock, then it's just R over here. If it's a dividend paying stock, it's R minus Q. If it's a currency, then it would be the interest rate, domestic interest rate minus the foreign interest rate. If it's a commodity with storage costs, then there's a plus U over here. If you have some benefits of owning it, then there's a minus Q over here. So basically, cost of carry is just, you can think of this slide as an addition and different version of this slide that we're just summarizing up every benefits or any cost we are considering when we are thinking about the pricing for futures for any kind of underlying assets. Okay, almost there. Now let's talk about the last slide. Last few slides. So far we have, so this chapter, the main focus of this chapter has been about how do we pin down that specific futures price? How do we know what futures price is? And again, what is futures price? Futures price is standing at the time point of today, a negotiation about some predetermined future time periods. What should be the price to exchange, to conduct a transaction of an underlying assets with some dollar value prices? We're deciding what that future prices is. But then can we also think about a relationship between the futures price, the price of this futures contract, and the expectations on the future spot price, the expectation on the spot price at some time in the future time periods? Are there a relationship between the two? And it turns out to be that, yeah, there is some relationship. And here we're going to discuss about what that relationship is. And you should know that this is actually an asset-specific idea. So different assets, there could be different relationship between their futures price and expected future spot price. So what are we going to see? The way we deal with it is now we are going to assume for a parameter that's called K. This K is the expected return required by the investor in such investment by investing in such underlying assets. It could be a gold, it could be a stock index, it could be a commodity, crude oil, any kind of assets. Suppose that now for this specific assets, let alone all futures transactions. This asset specific itself, the rate of return should be, the expectation of the rate of return should be determined. It should be denoted as K. K is the return on the asset itself. Okay, so that is what we are talking about over here. So now let's think about another situation, sorry. Now let's think about how do we take a futures price into our model or into our consideration. Suppose that we know that the futures price is at 0, and then this is the price to pay time t at maturity to buy that underlying assets. So to get ready, we need to prepare for this amount. The discounted value of F0 multiplied by exponential to the power of negative RT. We need this amount to buy such assets through the contract at time t. And then this amount of money is worth F0 multiplied by exponential to the power of negative RT at present. This is the present value of that futures price. Futures price, just think about it as some kind of dollar value. We discount it back to present. We need to get prepared for this amount to buy something that worth maturity. So I haven't showed you guys this notation yet, but understanding about notations, we have been talking about S0, right? What is S0? S0 is the spot price of the underlying assets. And ST is the price of the underlying asset, the value of the underlying asset. So basically, if we lock ourselves into a futures or a forward contract, that at present, this amount of money can be translated into the value of the underlying asset at maturity time periods, right? Does that make sense? Oh, yeah, I think it's also better to show you guys using a diagram. So this is the timeline. We are standing at time 0, and then we are looking at time t. Suppose that there is this such investment, such futures contract. It tells us that at time t, you can use F0 to buy the underlying assets. And the underlying assets also has a value. We transform this F0 into this underlying assets, and the underlying assets has a value of S capital T at maturity. And think of this thing as that's the dollar value that we will be paying at time t. And the present value of such thing equals to F0 multiplied by exponential of negative RT at present. So it's seemingly like if we get ourselves into this contract, it's seemingly like we are using this amount of money at present and transferring it into this amount at time t. Does that make sense so far? Everything okay so far? And then what do? We also mentioned that we are making some assumptions, right? We assume that an investment related to this underlying assets will give us a reward of a capital of small k rate of returns. So it basically tells us that this amount F0 exponential negative RT, this amount multiplied by exponential of kt should be equivalent to st. That's the idea. And then we can simplify this expression a little bit. We can express it as F0 A minus R capital T equals to ST. So basically, this is the relationship between the R, rate of return we use to discount all kind of future cash flows, and K, which is the rate of return of the underlying asset itself. Okay, so what is the benefit of expressing things in such fashion? So what is so cool about these expressions? So let's take expectations. Let's take an additional expectations. You guys have taken stats course, right? So you should know that this is an expectation iterated expectation, right? So basically, that's how we can take things out of expectation signs. So we're taking expectations over here. Expectations as T. When are we taking expectations on? We are taking expectation at time 0, time 0. So this thing we don't know, we cannot take things out of it. And then we know F0 can be taken out of it. Discount rate, T, K, everything is known at time 0. So at the end, we can express things as F0 equals to expectation of ST multiplied by exponential of power R minus K multiplied by capital T. Yes, question? Okay. So we know that this amount of money can be used to conduct an investment and to make sure that there are no arbitrage opportunities to investing it into the underlying asset itself. And at the end, we should be expecting for a value of ST. And this ST is a variable. It's a number that we do not know at present. But regardless of things, the next thing we do is let's take expectations on both the left-hand side and the right-hand side. F0 is a known number. It's not the expectation, exponential of R is known, T is known, K is known. K is known because we now already made the assumption on K. Suppose K is that expected rate of returns required by the investor on such underlying assets. Everything can be taken out of side. At the end, we end up with basically what I have on the slide. F0 equals to expectation T multiplied by exponential of K minus R capital T. Okay, no, R minus K. Because now we throw it from the left-hand side to the right-hand side, so the sign changes. So what is so good to make such expressions? Yes, question? What do you mean? It's very close to what I'm going to talk about next slide, but what do you mean by nothing goes wrong? Not necessary. So it depends on what assets you are talking about. So yeah, this is exactly what I'm going to talk about on the next slide. So just let me proceed, okay? So now the question is about which is larger, R or K? Which is larger? So R is a discount rate unit used for all kinds of assets on the market. It's a risk-free rate people use. But K is an asset-specific term. K is an asset-specific parameter. We can have a K for all kinds of different assets. So now the question is, what is the relationship between K and R? Like you just mentioned, if we have a K that exactly happened to be equaling to R, then our futures price will be exactly equal to the expectation of the future spot price. On the other hand, if we have a K larger than R or K smaller than R, we should be expecting for something different. So now what we see over here is that if we have a K larger than R, if K is larger than R, then here we have a negative discount rate thing. And then it makes that the F0 smaller than the expectation of ST. What does it mean? So why do we have different Ks, and why do we have K larger than R or K smaller than R? Think about it once again. What is R? R is risk-free rate. And when do we have actually a K that's larger than R? So just think about like what we see on the market, say the market rate of returns on the market or market premiums. In most kind of cases, the market return is larger than R. Why was that the case? It's because there is actually a positive systematic risk loadings on the market, on the equity premium, on the equities, on the equity that people could own. So what we mean by K larger than R is basically the situation when we are talking about a stock or a stock index. On the other hand, there are also assets that have a negative systematic risk. They are like protective assets like gold, like some valuable metals. These are they usually have negative systematic risk. They usually, when the market go up, they usually go down, and vice versa. So that's the different situations. And if you look up the data, it's actually what you can, what people can expect for. In most kind of this, the futures price will be smaller than the expectations about futures stock index levels. On the other hand, if you look at the gold prices, if you can extract people's expectations, you're going to see exactly the opposite. And things about like, what are the things? There are things like the government bound futures, something we'll be talking about very soon in the next class. These kind of things are that's relatively close to the discount rate, and that's what you're going to see. Their futures price are closer to people's expectation about the future spot price of such underlying assets. Okay. So yeah, that's pretty much about this chapter. It's a relatively shorter chapter. It's just that there are quite a lot of variations. We have just, so basically everything we are learning is just this very unified formula, but that it's just that there are some like additions, variations from according to different assets that we are discussing about the underlying assets of the futures or forward contracts. So for some kind of assets, when they have different properties, they may have non-income, non-yield, cost of carry. They may have storage cost, convenience yield, or when we are discussing about currency, futures, any kind of situations, let's just think about how we, what are the additions to the formula and how we can do our modifications. Does that make sense? Okay, so that's pretty much about chapter 5. And yeah, we're going to have a very hard time later, talking about chapter 6. Okay, so you guys may have a break now.